bond markets surging, gold surging, the dollar on the back foot. What does it all mean? And do stock markets care? That's the question we're going to be asking ourselves here today after we get some economic data that raises the specter of another global recession concern. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to be looking at here is a set of economic numbers that's come out over the past 24 hours, raising some worrisome concerns. And then take a look at the next big inflection point in the global macro story, the monetary policy announcement from the Bank of England. Let's talk about global growth first. And to put this in context, here is a look at the JP Morgan Global Composite Output Index. This is a purchasing manager index for the world at large, and this is the composite. That is to say, it takes in both the service sector and manufacturing, and it's overlaid with global GDP, just to give a sense for why we care about this. So you can see the PMI numbers approximate the trends in GDP, but also run more timely than them. We have the GDP numbers for most of the world coming out quarterly, and even then with a significant lag. The PMI numbers come out monthly and come out with quite a bit less lag, and as we can see here, approximate the trends with good alignment. So you can get a sense for where global growth is going much faster than GDP numbers will tell you that in these PMI numbers, and this is really why we care to look. As ever, the numbers are structured such that 50 is neutral, neither growth nor contraction. Above 50 is expansion. Below 50, economic activity is shrinking. If the further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. What we got today was an update of these global numbers for the month of January. There's been a release cycle that's been ongoing for a few weeks now across all of the major economies, and S&P Global typically puts this together with a number of global partners, as you can see the aggregate here done in conjunction with JP Morgan. And what we see should be sobering indeed. We have a 12-month low on global growth. So take a look at this composite index here in the blue. First of all, we see that global activity has been decelerating since the middle of last year. Obviously, that's a very significant contrast with what's been going on specifically in the U.S. More on that momentarily. But what we see here is that this down move here, not coming from the anemic manufacturing sector, which returns to growth here only just so, pops back over 50 in January, but from the service sector, which heretofore was the source of strength. As a matter of fact, we can see for the global averages, it is the service sector that's held up the total. Manufacturing has been going down and then sticking around basically a flat line. Why is this so scary? Well, as we've said many times before on the show here, global growth is made up primarily by three economies: the US, the Eurozone, and China, which together add up to 58% of global economic output. The remaining 42% are vendor economies for the most part, dependent on demand from the former three. So their influence is actually even greater than the 58% implies. Think the U.S. And the relationship with Canada and Mexico, obviously, as we've learned to great effect this week after the Trump tariff back and forth earlier in the week, where the president levied tariffs over the weekend, only to take them away less than 24 hours later, or at least to postpone them for a month. Think Eurozone and Central Europe or Nordic Europe or even the UK. Think China and all of the Latin American commodity exporters, Australia, New Zealand, the commodity exporters in Africa, certainly most of Southeast Asia. All of these economies dependent on on demand from China. So these three economies really are the pillar of where global growth comes from. And so when we see this slowdown right here, it's not just that it's slowing, it's also how the distribution of the slowdown looks that really makes this so concerning. It comes from the US. The last set of PMI numbers here, not surprisingly, looking very much like the global average, a little bit more chipper on manufacturing. Finally, a bit of growth there for the first time in about a half year. But the service sector taking a sharp down step, and that sharp down step giving us the slowest growth, again, in about a year. Moreover, if we take a look at a rival set of PMI numbers, this one coming from the Institute of Supply Management, they also released their PMI numbers for January today. Manufacturing was earlier in the week, and again, it's the same story. It turned out a little bit better than expected, 50.9 versus 49.8. But again, the service sector is where the issue is. Another miss and weakness. And when we look at the components, they are hardly encouraging. Employment holds about steady. That's a bright spot. But new orders come down, as do prices. Now, in terms of market reaction, these numbers gave us that powerful push higher in bonds. It also gave us a rebound from the lows in stock markets, although they ultimately didn't get very far from the ranges established over the past week and a half, 2 weeks, and in fact held toward the middle of the broader range for the S&P 500 since early December. But nevertheless, the markets looked at this and said, well, lower yields because of lower price pressure and because of lower activity growth, that's good. We like that. But under the surface is something that downwind might look much less supportive because, of course, what this implies is that the driving engine of global growth, the U.S. service sector, is finally showing some signs of wear and tear. Compare what we just got from the Eurozone and China to see why. So, again, here's what's going on with the U.S., a 12-month low on growth. In the Eurozone, the composite index just barely managed to scrape its way above 50, which amounts to the first time that this thing has grown since August of last year. October was basically flat at 50 exactly. So, sure, this was perhaps the strongest in about 5 months, but nevertheless, just barely growth is what this amounted to. So the situation in the euro area is still quite anemic. The situation in China is similarly steady, even though, again, here we saw the lowest reading since September. So a little bit weaker on overall Chinese economic activity, but then again, Chinese economic activity has been weak for quite some time. In fact, we can see this sort of steady anemic condition here going back to the middle of last year, which boils down to this. And this is really where the concern is. Since essentially May, June of last year, the trend has been toward a very strong U.S. and weakening conditions in the Eurozone and in China. China at this point is essentially flatlined, and the Eurozone is improving, but that improvement comes from getting out of contraction territory to being able to begrudgingly stand still. So hardly a strong showing. This means that the essence of global growth for basically half a year, all of this has been built and carried on the shoulders of the U.S. service sector. Why only the service sector? Well, as we can see right here, manufacturing has been in contraction. Moreover, we've just learned from PCE and CPI numbers that all of inflationary pressure in the U.S. economy still lives in core services. That is to say, inflation from the goods side is actually negative. Not by a lot, it's close to zero, but that clearly isn't where a pull from demand exists. So while the U.S. has been robust, that growth has mainly benefited domestic service sector providers, whereas the vectors to spread U.S. growth globally might have come from goods imports, those things that the U.S. typically buys from abroad, but there's not been strong demand for goods. It's been mostly services. And so the global economy hasn't benefited from the strong U.S. It hasn't spilled over. Now we appear to have a very meaningful misstep and a very serious threat to then what is the only pillar of global growth over the past half year. If we are going to converge back to similar growth rates then in Europe and China and the US, as we appear to be seeing here, we are doing it in all the wrong kind of way, where the US is slowing, not where Europe and China are picking up steam. Needless to say, this means that global recession risk is suddenly back on the menu. Granted, this is only 1 month of data. But if we are watching the start of a trend, then cheering for slower U.S. services because it means lower rates will very quickly turn into panic as you need lower rates, because you don't just then need them for a bit of maintenance to bring borrowing costs down, you need them to address a global recession. Because if the U.S. service sector is headed for ongoing slowdown, there really isn't a safety net to counterbalance that for the global GDP story. The next thing that we have to contend with as we assess global news flow shifts gears and takes a focus on the United Kingdom. Because how all of this now evolves certainly could benefit from the extensive commentary of a major central bank, much of which would be, of course, assessing global trends, both for growth and inflation. And so the next thing that we are going to keep an eye on here is what the Monetary Policy Committee, the policy-setting body at the Bank of England, is going to do when they announce policy. Now, a rate cut is overwhelmingly baked in already, so that much is probably not market moving any longer. We can see here the cut from 4.75 to 4.5 on the bank rate already in the market. We likewise see that this has been relatively steady now for the past several meetings. We're not so much removed on the current implied rates curve from where we were back in December, November, and obviously the main adjustment was really from September, where a hawkish shift in U.S. rates pulled almost everywhere else along for the ride. So it isn't the rate move that's likely to be of influence. It's what the guidance is going to look like. And needless to say, there's all the reason to think that this has implications for the global assessment altogether. Now, we are going to get a ton of guidance from the Bank of England this time. Not only are we going to get the usual minutes from the meeting, policy statement, and a press conference with Governor Andrew Bailey, we're also going to get an update of the quarterly monetary policy report, which is essentially the Bank of England's every 3-month revision of their underlying assumptions, of the lens with which they look at the economy and then decipher policy. So very, very big sort of day here, Super Thursday in the parlance of Bank of England watchers, where you get this onslaught of new information and then a press conference with the governor to explain what all of it means. Now, the trends have been at best conflicting. We can see there's been a little bit of a wiggle here in terms of economic activity. The economy just narrowly returned to a semblance of growth in January. We can see here it's been decelerating since the first half of last year, but it seems to have somewhat stabilized at neutral here as manufacturing improves a bit, even as services idles. So overall, the economy seems to be steadying here, if only briefly and if only at a low level. But at the same time, inflation hasn't really made a whole lot of progress. In particular, we can see that the core reading here, which excludes volatile food and energy prices, has been holding relatively steady above 3%, which is, of course, north of the Bank of England's target, since the beginning of last year, and isn't making a tremendous amount of progress. Moreover, the economic weakness that we've seen hasn't really translated into the places where you'd want them to disinflate the economy. We can see the biggest components here, the biggest inputs into these overall inflation readings are restaurants and hotels, hospitality, and recreation. These should be discretionary spending categories that should be amenable to economic slowdown to get prices down. Here's the economic slowdown, but prices are holding steady. So we can see that what we're really looking at here is inflation that's stickier than you might expect, at least at this stage. Now, we can see these were bigger contributors at the height of the COVID inflation scare, but whereas, for example, the influence of fuels, which is this, the influence of food prices, which is this, they've receded as COVID dislocations went away and supply chains normalized, and all those things the Fed called transitory inflation really did go away. These parts of the equation where inflation seems to be stuck and locked up in labor markets, hence the inability of seemingly discretionary spending categories to come in, that continues to bedevil the central bank. And so how this ultimately works out in terms of their guidance has a level of inherent volatility risk to it, because the trends from inflation and from growth seem to be at odds. Now, for the moment, we have a situation here where the Bank of England is expected to deliver 63 basis points in cuts this year, so that's 2 cuts, and 13 basis points next year, which means we're looking at about a 50-50 shot at a single rate cut next year. But 60 basis points this go-around essentially means that we have 2 cuts and about a 50-50 shot at a third one. So as it stands right here, the first one expected to come here in February, the next one on the menu by June, and then we'll see if we arrive all the way at a third one by December. The markets certainly seem to be tilting in that direction somewhat. The biggest sort of distillation of all the many different threads that the Bank of England is going to be unveiling here is probably going to be the voting pattern on the MPC. The way the committee works is a little bit different from other central banks. It's one policymaker, one vote, including the governor, who cannot override consensus. There's 9 of them on the committee. The expectation is that we're going to see a vote of 8-1, where 8 vote for a cut one votes to hold steady, and we get the cut. If that calculus is going to be different, if more policymakers, in other words, look at this inflation story and say, this is something that is troubling, we can't be as ready to cut rates, and it's not an 8-1 vote, but let's say a 7-2 vote or a 6-3 vote in the extreme or the more extreme case, the implication is going to be quite bullish, most likely, for the British pound. In the context of what we're talking about here, though, it will also mean that, much like the Fed, another central bank facing slowing economic activity but stuck inflation is being pressured to walk back rate cut intent, which of course is not good news if the global economy is slowing. In that environment, you want all the rate cuts that you can get if in fact the risk of global recession is on the menu. So it'll be very interesting to watch. For what it's worth, if we look at the economic surprise index for the UK, we can see that UK economic data has tended to increasingly underperform relative to forecasts recently, suggesting that perhaps the Bank of England will take the more growth-minded approach and will get the 8-1 vote as expected. Incidentally, if it's a 9-0 vote, that of course would be a dovish adjustment to expectations, and in that case you might see the British pound lower. You might see global equities cheer the prospect of readier stimulus or more consensus around a dovish perspective. But these sticky inflation readings suggest we may not see the surprise go that way. And in an environment where this is now becoming the story on global growth, and it is the one indispensable part of the puzzle that is faltering, getting to a place where we're not talking about more easing might be quite scary for risk sentiment in general, and of course for stock markets in particular. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.